What if I told you that the 2008 financial crisis wasn't a failure of the system, but the system working exactly as designed? While 13 million Americans lost their homes and unemployment doubled overnight, a handful of banking executives walked away with golden parachutes worth hundreds of millions. But that's not the conspiracy. That's just the distraction. The real story is what happened in the shadows. Between 2008 and 2010, the Federal Reserve secretly pumped over $10 trillion, not billion, trillion, into a shadow banking system that most Americans don't even know exists. They called it emergency liquidity. They called it saving the economy. But here's what they didn't tell you: that money didn't save your house. It didn't save your job. It saved the very institutions that engineered the collapse in the first place. And the mechanism they used? It's still running today. Bigger, faster, more dangerous. You're paying for it right now. In your rent, in your grocery bill, in the interest on your credit card. The 2008 collapse wasn't an accident. It was a controlled demolition with a very specific set of winners. Before we expose the exact mechanism, tell me, where are you watching from? Drop your city or country in the comments. I want to know how global this community really is. And if you're tired of the sanitized corporate version of financial history, hit that subscribe button. What you're about to hear won't make it to CNBC. Let's go back to where it all began, not 2008. Earlier, much earlier, the story starts in 1999. President Clinton signs the Gramm-Leach-Bliley Act, repealing the Glass-Steagall Act, a Depression-era law that kept commercial banks and investment banks separate. For 66 years, that firewall prevented your savings account from being gambled on Wall Street. Overnight, that protection vanished. Suddenly, banks that held your mortgage could bundle it, slice it, repackage it into something called a mortgage-backed security, and sell it to hedge funds in London, pension funds in Tokyo, and insurance companies in New York. Your home became a casino chip, and the house, literally, always loses. Sound familiar? Today, your car loan, your student debt, even your rent payments are being bundled and securitized. The machine didn't stop in 2008. It evolved. But here's where it gets darker. By 2004, the investment banks weren't just creating mortgage-backed securities, they were creating synthetic versions. These were bets on the bets, derivatives, credit default swaps, financial instruments so complex that the traders selling them couldn't explain how they worked. Goldman Sachs, Morgan Stanley, Lehman Brothers, they weren't just selling these products. They were betting against them. They knew the mortgages were garbage. They knew the ratings agencies, Moody's, S&P, were stamping AAA ratings on toxic assets because they were paid by the very banks creating them. It was fraud, institutionalized, systematic, and entirely legal. Sound familiar? In 2024, private equity firms are buying up single-family homes, converting them into rental portfolios, and securitizing the rental income. Your inability to buy a house isn't a housing shortage, it's a business model. Now, here's the piece they never teach in economics class. None of this could have happened without leverage. Banks were operating on 30-to-1, sometimes 40-to-1 leverage ratios. That means for every dollar they actually owned, they were gambling with 40. When Lehman Brothers collapsed in September 2008, it had $619 billion in debt. Its actual assets? $639 billion. A 3% loss in asset value wiped out the entire company. And they weren't alone. Bear Stearns, Merrill Lynch, AIG, all of them were running on fumes and ego. But instead of letting them fail, like capitalism supposedly demands, the Federal Reserve did something unprecedented. Something that changed the entire trajectory of the American economy. They didn't just bail out the banks, they became the bank's central counterparty in a shadow system that most people still don't understand. Sound familiar? In 2020, during the pandemic, the Fed once again flooded the system with trillions. Except this time, they didn't even wait for a collapse. They preemptively backstopped everything. corporate debt, junk bonds, even ETFs. The market didn't crash because the Fed wouldn't let it. But that money didn't go to workers, it went to asset holders. It inflated stock prices, real estate, and wealth inequality to record levels. Here's the pattern. Every time the system breaks, the solution is the same. Print money. Give it to the banks. Tell the public it's for their own good. Then watch as the middle class gets poorer while billionaires multiply. The 2008 crisis wasn't a black swan event. It was orchestrated. Not by a shadowy cabal in a basement, but by a regulatory structure designed to allow infinite risk with zero accountability. And the mechanism that enabled it all? It wasn't just derivatives or subprime loans. It was something far more insidious, something that's still active, something called the primary dealer system and the Federal Reserve's discount window. And the people who controlled it knew exactly what they were doing. Let's talk about the primary dealer system. Most people have never heard of it, and that's by design. Here's how it works. The Federal Reserve doesn't deal with you. It doesn't deal with your local bank. It deals with 24 elite institutions, mostly massive investment banks, called primary dealers. These are the gatekeepers of American monetary policy. When the Fed wants to inject money into the economy, it doesn't mail checks. It buys assets, treasury bonds, mortgage-backed securities from these primary dealers. And here's the kicker. The Fed buys at above-market prices. It's a direct transfer of wealth disguised as monetary policy. In 2008, when the entire financial system was on the brink, the Fed opened the discount window, a secret lending facility, and flooded the primary dealers with trillions in emergency loans. No congressional approval, no public debate, just unlimited money, printed into existence and handed directly to the banks that caused the crisis. Lehman Brothers? They weren't a primary dealer anymore when they collapsed. Coincidence? Maybe. But Bear Stearns, Merrill Lynch, and Goldman Sachs were, and they got backstopped. In fact, Goldman Sachs and Morgan Stanley were reclassified overnight from investment banks to bank holding companies, giving them direct access to Fed emergency lending. The rules were rewritten in real time, mid-collapse. But that's not even the wildest part. Between 2007 and 2010, the Federal Reserve extended over $16 trillion, not $10 trillion, but $16 trillion in cumulative loans through secret emergency programs with names like the term auction facility, the primary dealer credit facility, and the asset-backed commercial paper money market fund liquidity facility. You won't believe the names on the recipient list. We're not just talking about American banks. We're talking about foreign institutions, Deutsche Bank, Barclays, the Royal Bank of Scotland. The Federal Reserve, your central bank, funded by your taxes, was bailing out European banks. And the American public. We didn't learn the full details until a 2011 audit forced the Fed to disclose it. The receipt is wilder than you think, and it exposes the entire game. Let's break this down step by step, because this is where the conspiracy becomes undeniable. Step 1. The shadow banking explosion. In the decade before 2008, a parallel financial universe emerged. Not your traditional banks with tellers and ATMs. Shadow banks, hedge funds, money market funds. Investment banks operating like banks but without the regulations. By 2007, the shadow banking system held over $20 trillion in assets, larger than the entire traditional banking sector. These institutions were lending money, taking deposits, creating credit, all without FDIC insurance, without reserve requirements, without oversight. They were unregulated casinos, and they were critical to the housing bubble. Here's how it worked. A family in Nevada takes out a subprime mortgage. No income verification, no down payment. That mortgage is sold to a bank. The bank bundles it with 1,000 other mortgages into a mortgage-backed security. That security is sliced into tranches: safe, risky, ultra-risky. Rating agencies stamp AAA on the safe tranches, even though the underlying mortgages are garbage. Pension funds, insurance companies, and foreign governments buy these AAA-rated securities, thinking they're as safe as treasury bonds. They're not. They're time bombs. But here's where the greed goes exponential. Investment banks create synthetic CDOs, collateralized debt obligations that don't even contain real mortgages. They're just bets on the performance of other mortgage-backed securities. It's a copy of a copy. Leverage on leverage. Goldman Sachs created a synthetic CDO called Abacus. They let a hedge fund manager, John Paulson, pick the mortgages that would go into it, knowing he was betting against them. Then they sold Abacus to their own clients, never disclosing the conflict. Goldman made money. Paulson made $15 billion. The clients lost everything. This wasn't capitalism. This was moral hazard weaponized for profit. Step 2. The ratings agency. Scam. None of this could have happened without the ratings agencies. Moody's, Standard & Poor's, Fitch. These firms are supposed to be independent. They're supposed to objectively assess risk. But here's the problem. They're paid by the very banks whose products they're rating. It's like a student paying the teacher for an A. Between 2004 and 2007, Moody's rated over 45,000 mortgage-backed securities as AAA, the highest possible rating, reserved for the safest investments. Internal emails later revealed that analysts knew the models were garbage. One email read, "Let's hope we are all wealthy and retired by the time this house of cards falters." They knew. They all knew. And they kept printing AAA ratings because the fees were too lucrative to stop. In 2006 alone, Moody's earned over $800 million from rating-structured finance products. That's nearly half their revenue. When those securities collapsed, did Moody's face criminal charges? No. They paid a fine, $864 million, and kept operating. The fine was less than 1 year of profit. The system was designed to profit from fraud, then fine the fraudsters with their own profits. Step 3. The Federal Reserve's secret bailout. When the House of Cards collapsed, the Federal Reserve didn't just cut interest rates. They activated programs that most Americans still don't understand. The Primary Dealer Credit Facility, the Term Securities Lending Facility, the Commercial Paper Funding Facility. Alphabet soup programs with one goal: pump unlimited money into the banking system. But here's what's insane. These loans were made at near-zero interest rates. Banks borrowed trillions from the Fed at 0.25%, then turned around and lent it back to the government by buying treasury bonds at 3%. Free profit, infinite money. Between September 2008 and July 2010, the Fed lent out $16.1 trillion through emergency programs. That number is larger than the entire U.S. GDP at the time, and the list of recipients. Citigroup received $2.5 trillion, Morgan Stanley got $2 trillion, Merrill Lynch received $1.9 trillion. But it wasn't just American banks. Foreign institutions received $10 trillion, that's right. More than half the money went to foreign banks. The European Central Bank received $8 billion. The Bank of England got direct swap lines. The Swiss National Bank, the Bank of Japan, they all got backstopped by the Federal Reserve. Your central bank, using your currency, bailing out foreign financial systems. Without your vote, without your knowledge, without your consent. Step 4. The TARP lie. The public knows about TARP, the Troubled Asset Relief Program. $700 billion authorized by Congress to save the economy. But TARP was a distraction, a piece of political theater to make it look like there was oversight. The real bailout, the $16 trillion, happened in secret through the Fed's emergency lending programs. No congressional vote, no public debate, just unlimited liquidity pumped directly into the institutions that caused the collapse. And when the banks paid back the TARP money, politicians declared victory. See, the taxpayer made a profit. But they never mentioned the trillions lent at zero interest. They never mentioned the assets the Fed is still holding on its balance sheet. And they never mention the permanent distortion of the financial system. Step 5. The moral hazard era. Here's the consequence nobody talks about. The 2008 bailouts created a new rule. If you're big enough, reckless enough, and connected enough, you will never fail. It's called too big to fail, but it's really too big to prosecute. Not a single major banking executive went to jail. Not one. Angelo Mazzillo, the CEO of Countrywide, paid a $67.5 million fine but kept $470 million in total compensation. Dick Fuld of Lehman walked away with $500 million. Lloyd Blankfein of Goldman Sachs kept his job and his bonus. Meanwhile, 10 million Americans lost their homes. 8 million lost their jobs. Household wealth dropped by $16 trillion. The banks got bailouts. The public got austerity. Step 6. The shadow system. Today, if you think the system was reformed, you're wrong. Dodd-Frank was supposed to prevent another collapse. It didn't. It just made the banks bigger. The 5 largest banks in 2008 held 40% of U.S. banking assets. Today, they hold over 50%. And the shadow banking system? It's larger than ever. Private equity, hedge funds, corporate debt markets, they've moved the risk out of regulated banks and into unregulated funds. When the next crisis hits, and it will, it'll be faster and more global. In 2020, the Fed's balance sheet exploded from $4 trillion to $9 trillion in a matter of months. In 2023, when Silicon Valley Bank collapsed, the Fed created the Bank Term Funding Program overnight, another emergency lending facility, another backdoor bailout. The pattern is set. The precedent is locked. The game is rigged. And the final, most insidious truth? You're paying for it every single day. When the Fed prints trillions and hands it to banks, that money doesn't disappear. It flows into assets, stocks, real estate, commodities. It inflates prices. Your rent goes up. Your groceries cost more. Your wages stagnate while billionaires double their wealth. It's not inflation, it's theft. Legal, institutionalized, and permanent. Here's the brutal truth. The system that collapsed in 2008 was never fixed. It was rewarded. The institutions that gambled with your savings, that lied to investors, that triggered the worst economic crisis since the Depression, they're bigger, richer, and more powerful than ever. And the mechanism that saved them? It's locked in as permanent policy. The Federal Reserve can now print unlimited money and inject it directly into the financial system without congressional approval. That power didn't exist before 2008. It was created during the crisis and never rescinded. It's the ultimate safety net, but only for the banks. The next collapse won't look like 2008. It'll be faster, more interconnected, more global. We've got algorithmic trading, cryptocurrency contagion, sovereign debt bubbles, corporate debt at record highs, and a generation that's never seen a real correction because the Fed backstops everything. We're living in the era of borrowed time. Not borrowed from the future, borrowed from reality itself. And reality always collects. The biggest conspiracy isn't that the elites engineered the collapse. It's that they've convinced you it was a random accident, that it couldn't have been prevented, that the bailouts were necessary. They weren't. The banks could have failed. The executives could have been prosecuted. The system could have been reformed. But reform means accountability. And accountability means the people at the top lose power. So instead, we got denial. We got amnesia. We got the same people, the same institutions, the same mechanisms, just with better PR. Are we wiser now, or are we walking the same path in better suits? If this made you angry, if it made you question the narrative you've been fed, share this video. Post it where it makes people uncomfortable. And subscribe, because the truth doesn't go viral unless you make it. The elites want you to forget 2008. Don't let them. See you in the next one.